There will be consequences. And if there is not in the next year, year and a half, I'm probably just going to quit my profession. I don't have to have my newsletter and stuff, frankly. So I'm just going to quit.
Kitco News Outlook 2024 is brought to you by iTrustCapital. Buy and sell crypto, gold, and silver with your IRA.
Hello, I'm Michelle McCory in New York. This is Kitco News. U.S. Treasury Secretary Janet Yellen says that the U.S. economy is achieving a soft landing. Speaking in a CNN interview, Yellen says that she hopes we'll continue to see inflation ease without a significant economic downturn. And the IMF, or International Monetary Fund, is also forecasting a soft landing for the U.S. Kristalina Georgieva, the managing director of the IMF, speaking at Davos, says that she expects the U.S. economy to have a soft landing in 2024, similar to the one in the mid-90s, resulting in positive gains for the U.S. equity markets. And the big banks on Wall Street also have an optimistic outlook. Both Goldman Sachs and JP Morgan see U.S. real GDP at around 2% in 2024. Morgan Stanley and Bank of America see it at around 1%. And Goldman also expects new record highs for stocks as the economy slows down but does not contract. Well, my next guest says that there is no chance in hell of a soft landing after the biggest, most pervasive, and most artificial bubble in all of history. Harry Dent is still warning investors that what he calls the everything bubble could burst in 2024, with the biggest one-year crash ever likely to happen this year. And he says that there are two distinct signs investors need to watch for that confirm the collapse of our lifetime is indeed underway. Harry Dent is the founder of HS Dent. He's also known as the Contrarian. He has 4 decades of experience in forecasting, and he correctly called the 1989 Japanese housing crash, the dot-com bubble, President Trump's primary and presidential victory in 2016, and he's also an economist and best-selling author. Harry, very good to have you back on Kitco.
Nice to be back, Michelle.
All right, Harry, good to have you with us. And Harry, I definitely give you credit for never shying away from a forecast with specifics and timelines and being bold enough to make very clear calls. And before we get into your forecast for this year, we do have to acknowledge, however, that your calls for 2023 were not that correct. Now, granted, you certainly were not alone, and the general consensus for 2023 was that we would see markets sell off under strain of aggressive Fed interest rate increases and the economy slowing down, and that certainly didn't happen. But in your newsletter of January 2023, you wrote, "The coming year will be the worst for stocks and the economy since 2008, 2001, and 1973. And you were calling for the everything bubble to burst in 2023 when we spoke in late January of last year. And here are a few snippets from that interview.
Everything goes down. Stocks, real estate, commodities. Commodities have gone down the most first. Gold is holding up because it's seen as a safe haven until things failed. Same thing happened in 2008. But stocks are the lead now, and that's why I'm focusing on the NASDAQ, the more racy of the stock index. I'm predicting gold goes down to 900 to 1,000. That will be a lot less than commodities again, but that's still a 45% fall from here. So anybody thinks gold's going to protect you here, good luck. My projections, and again, going back to the same place, the 2009 lows, the S&P be down 86%, NASDAQ 92%, and the Russell 2000 about 92%.
Right now, in 2023, the S&P 500 rose more than 26%. The NASDAQ gained over 40%. The Dow hit a new record high, rising more than 16%. Gold gained 15% in 2023, and Bitcoin surged well over 156%. Now, Harry, you expected all of those assets to go down in what you then said was the next wave of this big crash. Now, to be fair, you did say in your January newsletter of 2023 that you thought the bubble would start to burst in 2023, but that the bottom would actually only hit by mid-2024. You wrote, and I quote you, "I'm predicting a crash of as much as 86% on the S&P 500 and 92% on the NASDAQ by mid-2024 or so." Okay, so technically not wrong yet, but you were expecting for things to start to unfold in a very dramatic way by now. Why do you think that didn't happen?
Well, the simple thing going on here, central bankers are determined to never have a recession again. They see recessions as a bad thing, which tells me, as somebody who's been involved with the highest levels of Fortune 100 company strategies and many, many new ventures and small businesses on the innovative end, failure is the secret to the free market capitalism. That yes, you have to have the freedom to innovate, new companies to grow, and not be over controlled and all this sort of stuff. But you also have to let failures get cleared out. Okay. And that's what they're not doing. When 2008 hit, and by the way, Michelle, I predicted that decades before it happened. Late 2007 was due to be the peak of the entire baby boom, massive spending wave as they got older into their peak spending from 1982 to 2007. And when that hit in 2008 and early 2009, and they saw how bad the economy got, they just panicked and started printing money. And they thought, oh my gosh, $1 trillion ought to get this economy back jolting and going. Well, it didn't. And now they've printed $8 trillion many, many years later, 14, 15 years of stimulus. I actually count $27.2 trillion, 9 trillion money printing, 18 trillion, basically deficits by the government. I mean, and you don't usually run deficits every year, especially in boom time. So they have fought a downturn with stimulus that nobody would have dreamed of. I admit, no, I didn't see 27 trillion in stimulus to stop this train. And on the other hand, anybody with the least bit of common sense would say, if you keep taking the easy way out and just printing money and just having the government spend more than they take in and worrying about the rising debts, and now we have the highest debt ratios, public and private, and the private is 3 times the public. I'm not even worried about the government and them defaulting. I'm worried about the private debt, which is 3 times the government debt. So this is something that has to come back into balance at some point. I and anybody else has died a million times trying to predict this because here's the thing. Once you start playing this game and keep stimulating, here's my thing. Here's where I'd give the Fed the greatest criticism. They had a chance in COVID to let the economy take a break for a good reason. Nobody would say there's something wrong with the Fed or the economy if we have a minor recession or something because of COVID, because people can't go out and spend money and can't congregate and socialize and all these things. But no, they doubled down. And $10 trillion of deficits in 2.5 years, $10 trillion, the biggest stimulus ever. And that's why we're still going. That if you have stimulus like this, you have to lag it forward a year to year and a half. So this stimulus is just starting to peak and wear off. And now, because they went so far in loosening, they finally did. And this was the mistake, going so far with overreacting with stimulus to COVID that they created 9% inflation literally overnight, okay? And then they had to go and tighten 525 basis points, and they may still have to throw in another quarter. That's the biggest tightening since the early 80s, which led to the biggest recession back then since the Great Depression. And I think you can't say this hasn't hit. It's going to take to the end of next year before we see, 2024, before we see how much it hits. But yes, am I humbled? Yes. Have they been able to keep this ridiculous overstimulated economy going? But is that good? Is it good if somebody keep taking crack to get high or they say, what's the problem when you have a hangover drinking? Drink more. That's what we've been doing, basically. And I call that bad policy, and there will be consequences. And if there is not in the next year and a half, I'm probably just going to quit my profession. I don't have to have my newsletter and stuff, frankly. So I'm just going to quit because this has gone on so long. If they really can keep a boom going this long with no consequences, then it's really true. Why are we working? Why are we investing, taking risks when all they have to do is print money and we keep going? So if that's the truth, then okay, fine. Really, people shouldn't be listening to me.
All right. Well, Harry, again, as I said, a lot of people went into 2023 with a very similar outlook as yours, and we did have unprecedented fiscal and monetary stimulus, but we also had a Fed reverse that policy.
They did.
And when you and I spoke, subsequent to that, the Fed tightened an extra 4 times when we spoke last end of January 2023. Each time by 25 basis points.
A year and a half. It hasn't hit yet. A year to year and a half before you know how much that stimulus is going to hit. So we won't know until the second half of this year whether we're going to be able to get through this and that the tightening was not too much. Okay, we won't know that till then. And the problem is by then things could be happening very fast. And when you bubble, people have to get, bubbles don't have soft. There's no soft landings really in history. Okay, of any consequence. Bubbles particularly only crash because they go to such extremes by nature when people are just investing in things because they're going up and they keep doing more and more. When it crashes, it's hard to stop those crashes once they get enough momentum. So what I'm really looking for, Michelle, and I really will kind of shut up and back off if we don't see this year, I am looking for a next wave down in stocks to gain some momentum, and it gains enough momentum once we hit a new low. And the magic number is 10,088 in the NASDAQ. If we break down through that, then we're in another big wave down. And I think that wave's going to have more momentum than the first. You go a lot lower. And then we see what investors think. Then we see if people don't start panicking, slow down on their spending and house buying and get scared of owning stocks. I mean, because right now, you have to admit, the Fed, what the belief is right now, the Fed will not let the economy or the stock market go down very much for very long. So there's no big risk. Well, first of all, that's bad. That means people have no discrimination if they think you can just throw money in the economy. And by the way, that's what the central banks are doing. They're just throwing money into the economy with no discrimination, just throwing it in, printing it, throwing it in by buying their own Treasury bonds, okay? Which they're issuing at record rates, but they can push interest and pushing interest rates down to well below what the market rates would be and think there's no consequences. So we'll see. But at this point, given how far they went on the stimulus side, which I wouldn't have thought they'd have gone that far, okay? But once they do, we don't know how the tightening,
right
now that they've gone the other way, 525 basis points. Again, that is the biggest tightening only rivaled by 1980-81 in history. In history, if that doesn't affect by the end of this year, when it should fully hit, then I'd say, yeah, well, they've created a magic wand here.
All right.
And
so
what am I doing poo-pooing this wonderful innovation?
So let's touch on that, because you said when the NASDAQ breaks below 1088, that is your signal that the crash is fully and effectively underway. Now, as we just discussed.
We did see a steep crash, 38% in the NASDAQ, 28% in the S&P in 2022. That is totally consistent with the first wave. Right. Major crashes like 29 to 32 throughout history. So only then did I say, oh, now it finally looks like the crash has started after they pushed it back. But now, if it doesn't follow through really pretty soon, then it's not.
But let's talk about what could make it. So, because listen, last time we spoke, the same points applied, and it would make sense. What you said logically makes sense. Hence, most people agreed with it, right? And we did see the Fed continue to tighten. And we also saw a banking crisis after you and I spoke, with 3 of the 4 largest bank failures in U.S. history. And yet we still saw market resilience. So what needs to happen? So what? I get that there was artificial. Give me a second here, Harry. I get that there was artificial intervention there. But what needs to happen then to cause this collapse? Are you predicting? If continuing to rise,
Nothing needs to happen. All that needs to happen is to continue to play out the past massive $10 trillion in 2-year stimulus. You know how big that is, Michelle? That has not even remotely ever happened any time in history as a percentage of the economy, just to keep this crashing train going, okay? That is going to hit increasingly into mid to late this year. That's what we see. The old stimulus has to wear off. That's peaking already, and that's going to start to go down. And the new tightening is going to hit at the same time, all in 2024. So unless you apply these lags, you can't make sense out of this. And so these lags will be able to fully work out the fading of the old stimulus, which was massive, and the full impact of the new tightening, which was also massive. Both of those will hit by the end of this year, and then we'll know. Until then, I don't care what I've said in the past. I don't care what anybody said. What I see, I would not have my money sitting in large cap stocks right now, hoping for the best. I'd rather be out for a year. They've been stretched so far. How much higher can they go? I'd rather forego those gains and not get hit by a crash. The next crash could be down. We could be down 60%, by the summer.
Well,
and
Harry,
to get out.
Well, there is a danger, of course, in sitting things out and foregoing those gains because you miss out on tremendous upside. I mean, you could say that being early is being wrong.
14 years of nonstop gains purely on artificial stimulus, no demographic support, no other things, fundamentals. What do you think the risk is at this point when they keep propping up and bubble, and somebody keeps getting drunk night after night? What's the risk that they're going to fall down on the pavement and break their skull? It's going up. That's all I'm saying.
It makes sense, but when we spoke last time,
take it. Be my guest. I'm not taking it. Period. You can do it, and the audience can do what they want.
Well, Harry, we're here to
this year if we can make it through this year with no cash.
All right, we are here to understand what you have to say. And again, I do want to point out that you did suggest shorting the NASDAQ at the end of January 2023. And even if you didn't short it, even if you just sat it out, you missed out on a significant upside of about 35%.
Absolutely. No question about it.
But
if you want to short, if you want to go long this market, you want to sit in stocks, be my guest. Anybody in this audience, be my guest. I'm telling you, I and anybody intelligent I know is not doing it because you can't keep going a bubble forever. There are people addicted to heroin that they can get massive toxicity until they finally fall over and hit the pavement and end up in the emergency ward. Okay, there's people that can go longer. This economy's gone longer than it should have. The stimulus has been heroic, but they did tighten. So now that they finally were forced to tighten, and again, they didn't have to over-respond to COVID. So that was a big mistake. Even if you're going to be a stimulus policy and you're going to say, we're not going to have a recession no matter what, so we're going to accommodate the economy, to overreact to COVID that much was a big mistake. And so until this whole thing plays out, again, old stimulus wears off, which is happening now, I'd say right about now, into the end of this year, and the new stimulus finally that they've already put in back in July will hit by the end of this year. The end of this year is when we can judge. I'd rather be on the sidelines judging this, because if we do have a crash, the market's going to go down way. I'll promise you this. If we do have a continued boom this year versus a crash, the crash will happen way faster and harder than the boom, because the boom's already so stretched. The crash has been prevented heroically by central banks, which to me is bad business. If you say you believe in free market capitalism, that means you let the capitalists in the markets make the decisions and you don't force it to grow.
No,
we've been forcing the economy to grow for 14 years.
Look, again, this obviously is a very manipulated market with a number of artificial stimulus and external factors. But I want to touch on. But hang on, Harry.
Really manipulated market. Be my guest.
Well, Harry, again, we're here to get your thoughts and your opinions. And again, we've noted that it's very challenging to call this kind of market. But you did mention, let's take it back to the Fed, because you did mention
by the end of this year. That's the safest thing to do. If you want to make money in a crash, you buy the 10 and 30-year Treasury bonds, the safest bonds.
We'll get to what you think investors should do. But you mentioned a little bit ago that you think the Fed is going to hike one more time. You said you don't think they're done tightening.
It doesn't even matter, but it just hurts a little more because all these things can move forward. But a 25 basis point hike is not going to make a big difference.
Okay, so play it out for me. Play it out for me. What do you see happening in 2024 as the stimulus starts to wear off and as the aggressive Fed policies start to kick in? What do you see happening?
The economy suddenly starts to slow for no obvious reasons. consumers have spent and keep borrowing and keep getting a new loan to improve their house, all that stuff, until there's nothing to improve and their kids have left and they don't even need the damn house they have, okay? That's a lot of people are in that mode, okay? So spending, the economy has to weaken and respond to this tightening. And I'm expecting, the only difference, anybody would expect this tightening to have some effect. I'm saying since they put off this tightening so long, and then when they finally tighten, they tighten hard, I'm expecting, they're thinking the economy can take it and it won't be a big deal. I think the economy can't take it. That's the difference. And if it does take it and there's no big deal by the end of this year, then I'm probably going to be out of the forecasting business.
Well, Harry, let's talk about the difference, though, between the market, the equity markets, and the economy, because many people would say that there is a growing disconnect between Main Street and Wall Street and the real economy, and people, paying their bills and going to the grocery store, of having a very different reality than, a NASDAQ that's up 40%, right? So many people would say you are feeling this recession and this downturn, just not through the metrics that we typically use to indicate that. We may have GDP looking robust, but that's due to government data, that's due to government stimulus, and we may have equity markets, looking healthy, but that doesn't mean that the economy is fundamentally sound. So there is certainly that point to consider as well. But but hang on, Harry.
Here's what I don't get. Here's what I don't get. If you want to help the everyday person stimulate the economy, why are you pouring the money into financial markets? Who owns the top 10% own 88% of the financial assets in the country, okay? You should be sending checks to people to spend on everyday things. If I do want to stimulate the economy and prevent it from cleansing, I still think the economy needs to take a big crap and a big nap, okay? That's my view.
Well, look, Harry, I don't know that you want to be sending stimulus to people. That's what we did. That's what we did in COVID. That's what we did.
People and not the everyday person.
That's what we did in COVID, and that's what got us into this mess, by basically sending stimulus directly to people. That's arguably what helped create this massive inflation, that the money was just spent and sent around to everyone. It wasn't just to the financial sector at all. That's how we got here. But anyway, but I want to get into the specifics. Okay, but Harry, let's get into the specifics now.
The financial markets collapse like they have in times after, and only after bubbles. Every bubble in history has burst, period, 100%, no exceptions, especially of this magnitude. These things burst the fast and caused the greatest, but the Great Depression, was not that big. It was 25% unemployment and an 89% stock crash simply from a stock bubble peaking and bursting. There wasn't even that big a real estate bubble because people couldn't get real estate loans like they can today. Real estate didn't bubble up like stock. Just a stock crash caused 89% unemployment when it finally hit, okay? And a decade of depression off and on. There is consequences to this. And again, if there isn't in the next year or two, I'll just quit and say, I don't know anything about anything. I've studied history, and if anybody studied more than me, I will kiss their you-know-what in public, okay?
Okay, look, Harry, again, nobody is saying that these policies, nobody is saying that these are the correct policies. Nobody is saying that these are the correct policies and that this ultimately is for the greater good. But let me understand. I just want you to give us your specifics. But give us the specifics of your forecast here. What do you see in terms of a downturn percentage-wise for the S&P, for the Dow, for the NASDAQ? Give me the specifics of your forecast.
First wave took us down 38% in the NASDAQ, 28% in the S&P 500, okay? Now we've had this bounce back to new highs and a few, but look, here's a classic thing for stock analysts. When you only see the generals make new highs and all the troops don't, that's called a huge divergence and a sign you're going to see another downturn. So the next wave, if I'm correct, the next wave would have to go lower than the first wave and from near highs in some indexes, not in the small caps and stuff. And that would end up having the stock markets, let's say by the end of 2024, down 50 to 60% instead of the 38 and 28, okay? So that would be the sign, okay, they weren't able to prevent this crisis. The stock markets are reasserting themselves saying, hey, something's rotten in Denmark. That would be the middle wave down, and every major crash in history has had 3 waves down, and the last wave would follow that. But most of the damage should be done in this next wave, and it should happen this year. Otherwise, we really do have a bubble and a non-burst for the first time in history. And I don't think anybody knows what to make of that, because that is never, ever, ever.
So you're seeing a 50 to 60% decline by the end of 2024 from where we are now? Or from
stocks from the top, and it's different and different. And we'll be down 50 to 60% and still have maybe one more wave to go after that. But that would be the sign that despite all this stimulus, and because they finally were forced to tighten, that the markets got. I'm just telling you, I know the markets. The markets don't want this, okay?
Sure.
The markets are being forced to take more and more crack and get more out of whack and not rebalance themselves. The markets are great at growing and expanding, and great at quickly. That's the secret to free markets. That's why George Gilder is my famous traditional economist. He says, you have to have the freedom to grow, but you have to have the freedom to fail. What we've been preventing since 2008, we're not allowing failure because they're scared failure will cause the whole castle to come down. And the truth is, it will after a bubble. And this record debt in all sectors, government, business, consumer, and financial sectors, all record debts beyond anything. You can't even compare this to the 1929 in the Roaring '20s bubble. Can't even compare this. Way more global, and it is an everything bubble. There's almost nothing that hasn't bubbled.
All right. Now, you said, though, that you see two specific signs that will give you an indication that this next wave of the crash is underway. And I'm not talking about by the end of 2024. You have a nearer term outlook in terms of confirmation. What are those signs?
Okay. Bitcoin is the lead dog. Okay. Bitcoin in crypto is, and this is a great sentence I got from an expert, Mark Yusko. The digitization of all financial assets and money. If that's not the next big thing, I don't know what is, okay? So Bitcoin is the lead dog in this new emerging industry, which is much like Amazon and the online retailers in the first tech bubble in the late 90s and early 2000s. That was a bubble in all tech stocks and stock, but those Amazon stocks, Amazon went from 6 to 136 in a year and a half and back to 6 in a year and a half, okay? That's a bubble, and that's a burst, and that's extreme. So I want to see Bitcoin starting to fail here. And oh, by the way, stocks are still edging up. But guess what? Look at Bitcoin. It went up to 48. That's right where there was resistance. And it's last I saw it was at 42. If Bitcoin breaks down like below 40, that's a sign that we're probably going into another wave down. And then stocks have to follow. And again, so Bitcoin breaking down sharply below 40 is the first wave. And then the NASDAQ, the lead dog in the stock arena, does have to break that first wave down low, 10,088. That'd be the second sign. If they can punch through that, not just test it and bounce off it, punch through that, that means we're going down faster. And that means that a major crash is underway. If we don't see both of those, then it's not really happening.
So Bitcoin, Harry, just to be clear.
If we just go sideways forever and never see a nice boom again, because we never did what free markets do best, clear the decks from all the bad debts. We have record bad debts and record zombie companies in our economy. That's what you clear out in recessions. The normal course is we have a recession once every decade and we boom for 7 to 8 years and then we slowly go into recession for 2 to 3 years. That's how an economy actually stays healthy, just like we're awake 18 hours a day,
sure,
and then we sleep for 6 to 8 to rebalance again.
Sure. I mean, and those are patterns that you see in nature.
We're not letting the economy take a nap, okay?
Right. And I get that. And that's the healthy way. And that's the pattern that you see in nature everywhere. But Harry, let me just...
You know how long the average person lasts if they couldn't sleep? 3 days before they turn into a crazy person. 3 to 4 days.
Okay. Well, sleep is very important, Harry. Let me just get some clarity here. You're saying, though, that Bitcoin is your signal that the broader crash is underway.
Just because it's the leader of the leading edge segment, which is cryptocurrencies, which is nothing about these stupid coins. It's just the coins are cheap IPOs, okay? So they can start a lot of companies. Most of these companies are going to be worthless and fail, okay? But it is about the restructuring and digitization of the entire financial services and financial asset industry. And I'm the only guy I know that knows in the world how much financial assets in the world. You want to take a guess? $630 trillion, 5 times global GDP at 105 trillion. So that is the next big thing.
So
I was
Bitcoin,
looking at crypto as the next big thing because it was acting like Amazon and the .com. But when that guy gave that definition, then I could see it would have to be the next big thing. If it can totally digitize and make more flexible and efficient the entire financial asset structure. It's the biggest number in the world financially. Biggest, I can't even, GDP is the next at 105 trillion.
right, and we've had Mark Yusko on this show a few times and certainly does have many pearls of wisdom there. But to be clear, Bitcoin is the canary in the coal mine for you. Specifically, Bitcoin dropping at what level?
From my point of view right now, yeah. If Bitcoin can keep going sideways to up, then I wouldn't expect stocks to fall this year. Until I see Bitcoin do that, I'm not going to expect stocks to follow.
But many in the Bitcoin world would say that there shouldn't be a correlation between Bitcoin and equities, that on the contrary, that Bitcoin is supposed to be a hedge against fiat debasement and devaluation.
Own little bubble world, and it is the next big thing, and they know it is, but they think because it's the next big thing, it can't fail and go down. Well, tell me why Amazon went from $136 to $6 in a year and a half when it was the next big thing on the same track. I am tracking the whole Bitcoin and crypto industry with Amazon and the internet industries 22 years before them. And you have 2 of these major innovation cycles in a 45-year innovation cycle technologically. So I've studied that too. So this is what I'd expect something to be doing what the .coms and online retailers, their breakthrough in the late 90s, in the last bubble, in this bubble. And I've determined it is Bitcoin and cryptocurrency, as crazy as it sounds, an invisible coin. You don't get crazier than that. That doesn't do anything. And like Warren Buffett doesn't produce anything. That's going to end up being the gold standard for a digitized world. That's my forecast. 20 years.
Okay, and certainly getting your point about innovation and technology, and certainly getting your point about Bitcoin being a potential future gold standard. The point that I'm trying to make is, though, that the fundamentals behind Bitcoin are very different from those of the equity markets, and one wouldn't necessarily expect a correlation. But there is.
No, they're not. That's what I figured out. They're acting exactly like Amazon and the .com stock, exactly on a 22-year lag. That's not different.
All right, even though the fundamentals are different there, and they're supposed to be appealing to different factors. Let's talk about gold.
Until somebody has been on an airplane and then stuck a damn jet engine on it.
All right, let's talk about gold, Harry, because one would think that gold should be behaving very differently from these other assets at the very least. In your January 2023 newsletter, you predicted that gold would be going down in 2023. I'm going to quote from you because I love this quote because it's so colorful. And you said in 2023, January, gold will go running to mommy with everything else before this crash is over. And unlike commodities, that crash will happen more dramatically and near the end, likely into late 2023 or later. Now, gold finished the year up 15%. And hit a new all-time high this year, December 3rd, 2023, $2,148.99 an ounce. Many expecting even bigger gains in 2024. Why do you not see that for gold?
You don't see much bigger. Okay, gold is also, again, this whole timeline is getting stretched because they're able to keep pushing this crash out. The whole thing is don't let Humpty Dumpty fall off the wall because he's going to crack and break. Okay, that's the whole Federal Reserve thing. They pumped up a big bubble. They didn't intend to. They were just trying to save us from the last bubble crash. Now they got this huge bubble and they can't let anything fall apart. Okay. So that's the whole game here, to keeping this thing together. Gold in the 2008 downturn and crash, which to me, I'm telling my subscribers, okay, that this next downturn is just 2008 recession, Great Recession times 1.5. 50% greater stock crash, 50% greater unemployment, all of that. It's just what the crisis needs to be to finish off and detox this whole greatest bubble in all of history, okay? So in that scenario, in 2008, gold held up in the early stages of 2008 and only crashed in the second 2 quarters, and then it crashed about 45% briefly and then went back up again. So gold was not the worst crash back then, but it did crash and went running to mommy when everything else. It was the last thing to crash. And I would see that happening here, that it's going to go up to, 2022, maybe 2,300, not a lot higher here, But if everything else crashes later in the next year or two, what I'm saying to substantial new lows, gold will follow. It proved in 2008 when things got really bad, it was not the safe haven. And what was proven to be the safe haven, but I don't know why I have to argue with Peter Schiff and people about this. The 10 and 30-year Treasury bonds went up 40 to 50% in late 2008 when everything, including gold, finally went down. It was the safe haven, and that's what I want to be sitting in. TLT, average 20-year Treasury bonds, and I'd rather, most people be better just to buy the 30-year. You're going to get 4.5% interest, and if things go bad, that will be the one thing that will damn near sure go up, because money's got to go somewhere, and that is the safe haven. And gold would be, if we had an inflation, if the government got so desperate that they printed so much money that it just became hyperinflation, like Germany back in 22. But this is not even remotely that. But if they did that, then gold would be the answer, and that's what Peter Schiff and the gold bucks think. That's the last thing. I am not buying gold, but I'd rather hold gold than I would tech stocks here.
But why do you think 20-year treasuries will do well if this whole system starts to unravel? I mean, that's a symbol of the system.
Any circumstances default. Corporate bonds, especially the more risky, can default. And it's default risk. And a downturn only brings lower inflation or even deflation, and that alone brings down yields in bonds, okay? So bonds normally benefit from a downturn, but bonds that can default, like the corporate bonds can, and especially the high-risk corporate bonds, those will go down and did go down in 2008 because of default risk. What will not default, if the U.S. government, for all these years, 14, 15 years now, can print money without abandon to keep the economy from collapsing, they can print money to pay off their bond. They will not default on the interest or the maturity of these bonds, and that's why they're the ultimate safe haven. A lot of corporations, even good corporations, may have to default or miss some payments, and that brings the value of the bonds down.
But Harry, one would argue that the value of the dollar backing those treasuries is drastically compromised when you are printing, because its purchasing power diminishes, it's devalued, it's debased, and not keeping up with inflation that's going to come if we start to print. Hence the case for gold, and for some for Bitcoin, and for some even for equities as inflation hedges.
You know, when I say about gold went down, you guess what the dollar did in the second half of 2008? U.S. dollar. And we had one of the worst.
It did. Yeah.
We're the best house in a bad. Are we good? Are we in debt? Yes, but Japan's more in debt than us. Most of Europe's more in debt than us. All the other developed countries are, except for Australia. Okay, so the dollar and the U.S. Treasury bonds will be the safe haven. But I want the Treasury bonds because they're locking in low, interest rates for a longer period of time and will benefit more when safe haven interest rates go with deflation, while risky interest rates like corporate bonds look more at the default risk. The Treasury bonds just see the deflation, which is the positive for bonds in a downturn. That's why Treasury bonds are the one and really the only safe haven if we have a 2008 downturn times 1.5, so that it's even worse than that. The Treasury bonds were the only thing that went up at the worst of that crisis. Only.
So in the scenario that you're expecting, equities are down, gold is down, Bitcoin is down, Treasury bonds, long-term Treasury bonds are the place to be. Any other safe havens, or is that it? What does real estate do in this scenario? Well, apartment, if you got to be in real estate, apartment bill is the only thing that'll hold it. They'll still go down because all the real estate will go down and that sort of stuff. And there'll be some default problems there. People won't be paying their rents and da-da-da-da-da. But if I was going to keep any real estate, I would keep stuff in the multifamily kind of apartment rental sector. And I wouldn't even keep that myself, but that's the one sector I would consider keeping. Everything else in real estate, this real estate does not usually bubble like this. It didn't even in the roaring 20s. But lending has been so free and exaggerated. Real estate will see the biggest downturn in history. Now, first of all, nobody expected in the last downturn,
The average house went down 34% at the worst, and it took 6 years to do it, from 2006 to 12. So longer slide, longer to come out, but down 34%. Just to go back to support and just to erase the gains, just in this last final bubble, not the previous bubble, we would have to see the average house go down 50%. That is the biggest thing that's going to hurt the everyday household. The everyday household doesn't own a hell of a lot of stocks, okay? And they're not even in Bitcoin. And if they do, there's probably their kids, and and they want the kids to learn a lesson anyway. So how I'm most concerned about real estate, because Bitcoin will come back and go higher, okay? Stocks will not. I think we're seeing highs we won't see in most stocks, and we're seeing highs in most real estate we will not see in our lifetimes for people like, say, over 40 or 50. I don't think we'll see in the U.S. because we're now going to start slowing like Japan and other developed countries have, that sort of thing. But Bitcoin will come back because it's the next big thing. So I don't want to hold Bitcoin, because I actually have a target of 3,250 to 4,100 on Bitcoin, or at least 10 to 11. If it gets there, then I'll start buying, okay?
Wait, 3,250, 3,250 is where you think Bitcoin could test
they had before the last bubble. It's just, if you look at a stock chart, it goes 1, 2, 3, 4, 5 peak. And then when it crashes, it goes just back to the 4-wave low before the 5 peak. That's all Bitcoin would be doing, to go all the way down to 3,250, just retesting the late 2018 bottom after the last peak from 69,000 crash. The last peak from 20,000 crash down to 3,250. It's all it's doing is testing the last major low. So if I was looking at a chart and didn't know what it was, and I didn't know it was crypto, and I didn't have any ideology, it can't go this low because of this and the cost of this. And I get these arguments all the time because I'm in crypto land. All the crypto people are moving to Puerto Rico to save tax capital gains in the future, okay? If I just saw the chart, it'd be a slam dunk. It's going back to the 4th wave low. That is 3,250.
All right. Well, I'm glad you're bringing up models and charts, because in your latest newsletter, you did run through a very interesting analysis of what you called the bubble model for stocks from Masters and Johnson's orgasm model. And you say you've been using this model to outline bubbles in markets. Why don't you talk us through that? Because you make the comparison to male orgasms, female orgasms, and bubbles, which I'm sure our viewers will find very interesting. And you start off by pointing to the Dow bubble of 1929, the Nikkei bubble, and the first NASDAQ bubble, using this orgasm metric, if you will. So we'll pull up those charts, but maybe you can run us through the thinking there.
Yeah. Okay. And so what is an orgasm? Now I'm talking the male orgasm, okay? Male orgasm, you get excited, it goes up. It's extreme excitement. It's not just hum-de-dum and things are getting better, yo-de-do. It's excitement, and it gets so intense, it can't last. That's why bubbles have to burst. So that's what the orgasm does. When I lay that Masters and Johnson's, independent from a different arena, over any major bubble in history, it fits better than anything else. Now, what I bring up the female orgasm is females tend to have multiple orgasms. I don't even be 2, 3, 4, 5, whatever. But the typical, what Masters Johnson said, the average must be 3 orgasms. Well, you look at the 1987, the 2000, and 2021, 3 bubbles in a row. Well, now you got, on a bigger picture, the female orgasm. So bubbles, I tell people, bubbles are, and I don't mean it's kind of, somewhat, maybe, they are exactly like financial they are exactly like orgasms. And it's just in a different arena. And if the model, when you put the Masters and Johnson's model, and they're not measuring stocks when they did this model, and it fits so well, it's kind of like, well, maybe, and it makes sense because bubbles are intense. And the thing about bubbles is people always they go up so much, so fast that even the people out of them eventually get drawn. I think Irvin Fisher in 1929 fought that bubble and finally got in at the last minute before it crashed. The bubbles draw everybody in, and then they go down. And then after they crash, people go, how could we miss this? How could we have been so stupid? It was a bubble, damn it.
So to recap,
you know why they don't see it, Michelle? They're too high on the bubble to see it. People high don't make good decisions.
But in your newsletter, I believe you were saying that the current wave crash that we're in more resembles the female orgasm. Is that correct?
No, the succession. I said like succession of waves, 87, 2000, 2001. Those were three bubbles, each one getting 87. When 87 at that time, we'd never seen that big a surge in a short period of time, and a 40% crash in a couple of weeks. That had never happened before that, not even in the 1929 crash. Okay, so that was a sign. If you'd have been awake, and I didn't get that back then. Oh my gosh, we're going into a bubble era. The baby boom is so strong. Inflation's falling from such high levels, caused by the cost of the baby boomers getting in the workforce. That's why inflation was high in the 70s. It wasn't government deficits. We've had way bigger government deficits with inflation now. So all of that extreme thing caused this kind of orgasmic kind of scenario. And it turns out that this orgasm model from Masters and Johnson is the best corollary I can find to say this is what it looks like. So if something goes up that extreme, and that's what I say, everybody's hoping on a soft landing here. And this is when I'll quit my profession. If we can get through the next 2 years with a soft landing and the markets only go down 20 or 30% and nice and orderly, and we get inflation down to 0 to 2%, and we don't have any big crash and big failures of companies, then I'll say, you know what? We're in a new economy, and I need to retire.
All right. Well, Harry, I definitely get the connection between orgasms and the baby boom. That's a very clear correlation there. But let's talk about then why you think this may not happen. What would need to transpire for you to have to retire, as you put it? What could possibly derail this? What needs to happen to, maintain this path that we're on without this major crash that you're thinking is absolutely imminent and inevitable?
Well, again, here's the problem. The Fed already overstimulated when they didn't need to. COVID would have been a perfect excuse to let the economy grow a little slower and work off some of this excess. They already overstimulated and then over-tightened. That tightening, even if they start changing their policy today, that policy is going to take a year and a half to hit. And so a lot of this could still follow through. So they've already laid the groundwork for a crash to start to develop that's hard to stop. So that's what I'm looking for. If we can see a crash, and hard to stop means it's got to go below that last low. If we can't break 10,088, then it's not that hard to stop, okay? So I'm looking for that this wave already looks like it may be turning over to me. Bitcoin is leading it. That's my first sign. Bitcoin should lead this if it happens. It is so far. It's already dropped from 48 to 42 in a short period of time. It has to keep going, okay? If that happens and if stocks start dropping sharply and then it breaks that last low in stocks in the first crash, then it's going to be hard to stop because people are going to finally say, well, we thought the Fed was in control, but they're not. And the truth is, there's not a Fed official or chairman in all of history that's ever had sex or run a business, okay? Not a one. So these guys just know how to manipulate and print money, which is the thing. They don't understand the economy from my point of view.
All right, Harry, let's talk about another big factor here, and that is elections and geopolitical risks, because that could arguably accelerate any kind of downfall. In fact, even Goldman Sachs concedes that U.S. elections are the second top risk to markets and the global economy this year, preceded only by geopolitics. Now, should there be major developments on those two sides, that could certainly impact everything. That could lead to this everything bubble bursting. And Goldman Sachs saying that's very difficult to position your portfolio given these new risks. Now, you did correctly forecast the victory of President Trump. What are your thoughts on what we can expect for our elections 2024?
Well, a challenging economy kills the incumbent. So if we even have a continued very slow economy, 2024, Biden is dead. Biden's also not a dynamo, okay? I mean, he's a nice guy. I like him, but he's not a dynamo. Trump is a dynamo, but I hate to say it. I mean, he acts like a crazy man. Do I want him in charge? I personally feel like it's an embarrassment to the world if he's president for a second time. That's just my personal point of view. I don't disagree with him on half or more of his policies. I just think, he's not the right guy for this. But what I would tell any politician, if I was advising Biden, I would say step out gracefully while you can. You're a dead man. If this economy is flat to down this year, if I'm even half right, you are dead. And people blame the president in office for what's occurring now, in the current time, and they usually have very little to do with it. These things are already set in motion. This 2008 crash, I was predicting back in the early 1980s, for crying out loud, okay? So I wouldn't want to be the politician in office when that happens, because people will blame you whether or not. Biden's not the cause of this, but if the economy's weak this year, there's not a chance of him getting reelected. And I'm hoping somebody other than Trump gets it, because otherwise it's going to be hard for him to get more than 40% of the vote because he's so kind of controversial. But if the economy goes down, it's going to definitely embolden. It's definitely going to be good for the attacker, or especially Donald Trump. So that's Donald should be praying for this economy to go down.
Well, what do you make of this, Harry? Because there's a lot of buzz that Biden may not, in fact, even be the Democratic nominee. In fact, even JP Morgan has come out and said that amongst their top 10 surprises for 2024 is that Biden will actually withdraw from the presidential race between Super Tuesday and March 5th and sometime before the November election. And then he could be replaced by another candidate named by the DNC. There's some names floating about, from Gavin Newsom to even Michelle Obama. Now, again, not technically your forte, but you were very correct in predicting a Trump victory very early on, before he even won the primaries. So what do you see happening if Biden is not, in fact, the Democratic nominee? Does that seem like a scenario that's realistic to you?
In a weak economy, just the fact that the economy has been strong for so many years increases the chance that it'll at least be weak this year, just because you can only do so well. So in a weak economy, the Democrats' only chance is to not have Biden and have a new dynamic candidate. Okay, that's their only chance. I think in the type of steeper downturn I see is more likely that the incumbent, the attacker, the new candidate, whether it be Trump or another Republican like Nikki Haley, are going to have the advantage no matter who they put in there.
Really? So even if the Democrats...
economy, they're going to be blamed, but Biden is going to be blamed 100%. So he has no chance if the economy's either weak or down.
So you're thinking that a Republican winner is pretty inevitable either way right now?
Yes.
Wow. All right. Bold words. What I like about you, Harry, is you never mince your words. You always take a position, and you have to respect that. Right or wrong, have to respect your gumption. So we're going to have to leave it there. We will, of course, be checking in again with you, but thank you so much for your passion.
Dent.com. Get on my free newsletter. This is the time to be on it. I mean, you ought to be listening to a guy like me just in case I'm right, because this is going to be extreme one way or the other.
Definitely harrydent.com, and it'll definitely be a volatile 2024. I think everybody's sort of on board with that one, and we'll be checking in with you again. So again, thank you for joining us, Harry. As always, we appreciate it.
Thank you, Michelle.
All right, thank you. And as always, thank you for watching. From me, Michelle McCory, and the rest of the Kitco team. We'll see you again soon.
Kitco News Outlook 2024 is brought to you by iTrustCapital. Buy and sell crypto, gold, and silver with your IRA.